For thousands of years, economic collapses have left fingerprints. Empires rise, currencies weaken, and just before the system resets, gold and silver send the same warning signal. That signal is flashing again, brighter than at any point in modern history. History does not repeat perfectly, but it rhymes with unsettling accuracy. In the late Roman Empire around 284 AD, during Spain's decline centuries later, in the Netherlands following its golden age, and again in Britain before it lost its global financial dominance in 1931, one pattern consistently emerged. In the years leading up to each systemic breakdown, the prices of gold and silver surged dramatically, often doubling or tripling, before the broader economy finally fractured. These weren't coincidences. They were warnings. Today, we are witnessing that same historical signal unfold in real time. In early 2024, silver traded near $22 an ounce. Fast forward to the present, and silver has surged past $70. Gold has followed a similar trajectory. This is not a routine rally or a speculative spike. It is one of the most aggressive precious metals advances seen in over 4 decades of data. Markets do not move like this without cause. A sharp, sustained rise in gold and silver prices has always been a reflection of something deeper than supply and demand. It is a vote of no confidence in currency itself, specifically, confidence in the purchasing power of the US dollar. When investors collectively begin to doubt the long-term value of money, capital migrates toward assets that cannot be printed. Once that migration begins, history shows the countdown to a major redistribution of wealth is already underway. The modern financial system is intentionally complex. Layers of jargon, charts, and abstractions create the illusion that only professionals can understand what's happening. But beneath the surface, the mechanics are remarkably simple. When you strip away the noise, the system reduces to a handful of forces that repeat across centuries. Understanding those forces does not require advanced degrees, only clarity and historical awareness. What we are witnessing today has happened before, many times. And the sequence that follows is remarkably consistent. To understand where we are headed, we must first understand why gold and silver are rising now, not emotionally, but mechanically. The explanation begins with debt. If we chart total U.S. debt, both government and private sector combined, against the size of the economy, the picture becomes stark. In the early 1980s, total debt amounted to roughly 1.5 times US GDP. Since then, it has exploded. Today, total debt stands at roughly 4 times the size of the economy itself. That means for every dollar of productive output, $4 of debt exist. This expansion was not accidental. Over 4 decades, the financial system issued vast quantities of credit, creating an artificial growth cycle fueled by borrowing. But debt at this scale is not meant to be repaid. It cannot be repaid without collapsing the system that depends on it. The probability of full repayment is effectively zero. We received a preview of this reality in 2008. As households and banks began defaulting, the system cracked. But something important happened after the crisis. Contrary to popular belief, the debt was never resolved. It was never eliminated. It was simply transferred. Before the financial crisis, households carried the majority of the debt burden. Household debt relative to GDP peaked near 100%. After the crisis, household balance sheets improved. Debt ratios fell. But the total debt burden did not decline. Instead, it shifted onto the federal government's balance sheet. As household debt fell, government debt rose in near perfect opposition. What was once private liability became public obligation. Government debt relative to GDP climbed from roughly 50% before the crisis to well over 100% today. This was not a coincidence, it was policy. Under normal circumstances, a debt unwind is painful. Excess borrowing fuels economic booms, but the correction phase brings contraction, unemployment, and asset deflation. Rather than allowing this process to occur, governments chose intervention. Massive spending programs replaced private demand. The pain was delayed but not erased. This decision explains gold's behavior over the last 2 decades. When government debt expands rapidly, gold tends to rise alongside it. The relationship is not philosophical, it is mathematical. Governments that borrow in their own currency always retain one final option: devaluation. Unlike households or businesses, governments do not default in the traditional sense. They print. Investors understand this. And when debt reaches a scale where repayment becomes implausible, capital begins preparing for the only remaining outcome: currency dilution. This is why gold and silver have become monetary barometers. Their rise reflects expectations, not panic. It reflects investors' positioning ahead of currency devaluation rather than reacting after it occurs. What is often misunderstood is that this process unfolds in stages. The first stage is institutional awareness. Professional investors move first, shifting capital into hard assets quietly and methodically. That is where we are now. But history also teaches that this phase does not remain isolated to precious metals forever. Eventually, confidence erosion spreads beyond markets and into daily life. That is when currency devaluation stops being theoretical and becomes visible. Prices for essentials, housing, food, energy, begin rising together. That moment has not arrived yet. In fact, when we examine recent data, the divergence is striking. While gold has nearly tripled over the past few years, oil and natural gas prices are significantly lower. Agricultural commodities like wheat have declined. U.S. housing prices, on average, have stagnated. This seems contradictory until we examine money velocity. Velocity of money measures how frequently currency circulates through the economy. High velocity means money changes hands rapidly, pushing prices higher. Low velocity means money stagnates, suppressing inflation even amid heavy spending. Over the last 3 decades, money velocity has collapsed. In the late 1990s, each dollar circulated nearly twice per year. Today, that figure is closer to 1/4 and falling. This explains why inflation has moderated despite unprecedented government deficits. In true currency collapses, velocity spikes violently. People rush to exchange currency for goods before purchasing power evaporates. Spending accelerates. Prices follow. That has not happened yet. Why? Because a massive portion of today's money supply is trapped inside financial assets. Stocks, bonds, and speculative investments absorb liquidity without circulating it through the real economy. The U.S. stock market now represents the largest share of total monetary wealth in history. And that wealth is concentrated among a small segment of holders who accumulate rather than spend. As long as financial assets continue rising or holding value, this money remains frozen. Velocity stays low. Inflation remains contained. But if confidence in financial assets breaks, if stocks experience a sustained decline, that trapped liquidity could be released. Selling converts paper wealth into cash, which then seeks real goods, services, and tangible assets. That is when velocity surges. That is when inflation accelerates. This is the final stage of currency devaluation, and it is the most disruptive. We believe this transition is likely within the next several years, not the immediate future. Understanding this timing is critical. Long-term risks are real, but markets do not move in straight lines. Opportunity exists in both directions, across asset classes, when approached with discipline rather than ideology. The goal is not fear, it is positioning. Those who recognize structural shifts early have time to adapt. Those who wait for headlines usually pay the highest price. Precious metals are not the end of the story. They are the signal that the story has begun. History has already shown us what comes next. The only question is who chooses to listen.